If you are a homeowner age 60 or older and have not reviewed your tax circumstances in the past year, these next few minutes might be the most crucial financial alert you receive this year. I am not saying this to cause alarm, but because what is unfolding quietly within the IRS now could lead to liens on homes, depletion of retirement funds, and financial turmoil for seniors unaware they are out of compliance. The window resolve this closes on April 15, 2026. Not this spring, not by year end, but precisely April 15th. After that date, your options diminish greatly while penalties remain. I have devoted years to studying IRS enforcement trends, tax law changes, and federal policies affecting everyday Americans, especially seniors who have invested decades building home equity and planning for a steady retirement. I can confidently say that what is happening in 2026 is unprecedented in terms of how aggressively the IRS is pursuing unreported property-related transactions among seniors. This is not speculation or fear-mongering. This is an actual shift in enforcement fueled by billions in new IRS funding and advanced technology unavailable even 3 years ago. So I need you to watch this entire video without skipping or leaving early, because the information builds step by step, and the recommended actions at the end only make sense with the full context. If you know a parent, spouse, sibling, neighbor, or anyone over 60 who owns property, send them this video immediately, not later, because those most at risk are often the last to learn. Let me explain why 2026 marks a turning point. For many years, the IRS worked with a limited budget, outdated technology, and a relatively small enforcement team compared to the volume of tax returns filed annually. This resulted in low audit rates, undiscovered compliance gaps lasting years, and millions of Americans, many seniors, making common housing-related financial decisions without knowing tax reporting was required. They added children to deeds to avoid probate, took home equity lines for medical bills, rented spare rooms on Airbnb for extra income, inherited homes and continued living in them, all actions that can trigger IRS reporting duties. Most people didn't know because the IRS lacked capacity to detect them before. That time is gone. In 2022 and 2023, Congress allocated nearly $80 billion to the IRS through the Inflation Reduction Act, much of which is dedicated to enforcement and modernizing technology. The IRS used this to develop automated data, matching systems, pulling information from county property records, mortgage lenders, home loan providers, title companies, short-term rental platforms like Airbnb and VRBO, and estate filings. All this data feeds into AI and machine learning algorithms that cross-check it against filed tax returns for discrepancies. The group flagged most often right now is homeowners over 60 with significant equity, not due to targeting seniors maliciously, but because this group has the highest number of recent unreported taxable events and historically less awareness about reporting obligations. Now, here are the key triggering events that likely apply to you or someone you care for. First, taking out a home equity loan or line of credit and using the funds for anything other than home improvements. Inflation has made seniors rely on home equity more to cover rising living costs like groceries, utilities, medications, or other expenses. Using these funds for credit card debt, tuition, or medical bills is common and understandable. However, current tax law, specifically the Tax Cuts and Jobs Act of 2017, changes effective through 2025 and enforced rigorously in 2026, allows interest deductions only if funds were used for buying or substantially improving the home securing the loan, as detailed in IRS Publication 936. If you used funds for other purposes but claim the interest deduction, that's an incorrect deduction now detectable via lender data matching. Penalties include the tax owed, interest from the return's original due date, and possibly a 20 accuracy-related penalty under IRC Section 662. For seniors on fixed incomes, this can amount to thousands of dollars. Second, adding a family member to your home's deed, something millions of seniors have done to avoid probate or safeguard the home from Medicaid recovery or simplify family matters. From a tax viewpoint, this deed change is a partial property transfer treated as a gift under IRC Section 251. Gifts exceeding the annual exclusion, $18,000 per recipient in 2026, must be reported on IRS Form 709. For example, transferring a 50% interest in a $400,000 home equals a $200,000 gift, requiring filing. Failure to file triggers penalties under IRC Section 6651. Moreover, gifting property during life passes your original cost basis to the recipient, carryover basis, while inheritance provides a stepped-up basis based on fair market value at death, which can drastically reduce capital gains taxes. Therefore, gifting can create unexpected tax liabilities for heirs. The IRS identifies unreported gifts by cross-referencing county deed records with Form 709 filings. Unmatched transfers get flagged automatically. Third, rental income from your primary residence, which has surged as platforms like Airbnb and VRBO make renting easy. Extra rental income can be vital for seniors managing on fixed incomes. However, earning rental income converts part of the home to income-producing use, requiring reporting on Schedule E, along with proper expense allocation and depreciation accounting. Third-party platforms must issue Form 1099-K for gross payments over $600, which the IRS receives. If rental income isn't reported, the IRS detects the mismatch between 1099-K data and your tax return, generating automated notices like CP2000. Ignoring such notices can result in final tax assessments and potential liens on your property. Fourth, the inherited property documentation gap, which affects those dealing with loss. Inherited property benefits from a stepped-up basis under IRC Section 1014, meaning the basis reflects the fair market value at death, reducing capital gains taxes when sold. But this benefit requires proper documentation, including qualified appraisals near the date of death and IRS Form 706 for large estates. Without this, the property is assumed to have a zero basis, dramatically increasing taxable gains upon sale. The IRS is now cross-checking estate and probate data with sale records to identify undocumented bases. You might wonder how the IRS knows about these events, how they find additions to deeds, Airbnb rentals, or missing appraisals. The difference in 2026 is the digital infrastructure created with new funding. Data from county recorder offices, mortgage lenders, title companies, rental platforms, and estate courts flow into connected federal databases. Machine learning compares this data to tax returns, seeking discrepancies, not suspicious behavior, such as missing gift tax filings, unreported rental income, improper interest deductions, and undocumented bases. When matched data reveals gaps, the IRS sends notices stating they have already identified issues. Waiting to receive a letter before acting is the riskiest choice because voluntary compliance options that could reduce penalties expire after April 15, 2026. IRS policy favors taxpayers who proactively correct errors before IRS detection with penalty abatements and reasonable cause relief available under specific provisions. Here's what to do now. 1. Collect all documents related to your home and finances since 2022, including purchase papers, closing statements, records of home improvements, receipts, invoices, home equity loan or line statements with usage evidence, deed or title documents showing ownership changes, and rental income and expense records if applicable. 2. Compare these documents with your last 3 tax returns, checking for inconsistencies such as undocumented home equity loans, missing gift tax forms, rental income not reported on Schedule E, or property sales without proper reporting. 3. Consult a qualified tax professional, either a certified public accountant, CPA, or an enrolled agent experienced in real estate taxation and IRS penalty matters. Verify their expertise in IRS penalty abatement related to property issues before hiring. 4. Create an account at irs.gov to access your tax transcript for free. This transcript shows all processed returns, issued notices, and third-party reported income like 1099s or 1099-Ks. This helps you know exactly what the IRS sees. 5. Respond immediately to any IRS notices you have received. If deadlines haven't passed, reply promptly. If they have, contact a tax professional to avoid escalations from notices to collection actions and property liens. Beware of scammers exploiting this situation. The IRS always contacts taxpayers by official mail, never by phone, email, or text, demanding immediate payment or personal info. They don't accept gift cards, wire transfers, or cryptocurrency. Ignore and delete suspicious contacts. If you are currently planning your estate or thinking about transferring your home to heirs, consult both a tax expert and estate attorney before making changes like adding children to deeds. This strategy can cause gift tax reports, remove stepped-up basis benefits, and attract IRS scrutiny. There are safer alternatives like revocable living trusts, transfer on death deeds, and proper testamentary transfers through wills depending on your state and family goals. To sum up, the IRS has unprecedented data, technology, and enforcement power in 2026. Seniors with unreported property transactions face increasing scrutiny. The voluntary compliance window closes April 15th, so act now. Gather documents, review returns, seek professional advice, check IRS records, and promptly address notices. These issues arise partly from a lack of awareness, not wrongdoing. The difference now is prompt, informed action. If this information helped clarify your situation, please like this video to help others in need. Subscribe to stay updated on tax and policy changes, and share this with anyone over 60 who owns a home. Your could save them thousands and reduce stress. Drop your questions in the comments, as each one could inspire future videos. Thank you for watching Full Breakdown. I'll see you next time.